The general market economy is debatable whether or not we're in a recession, or if we're in inflation, or if there's going to be another pullback of stocks. One thing is certain is that there's an explosion in the demand for surety bonds for business. We're not talking about bail bonds, we're talking about surety bonds for business. And a lot of this demand happens to come from companies looking to replace other financing facilities or credit facilities, such as lines of credit, such as capital reserves on your balance sheet, by using a surety bond to entice business partners to go ahead with a project. If you're looking at a large construction project and your business partner is looking to see if you have deep pockets to be able to withstand and make it through that project, you'd have to show them letters of credit from your bank that you have, $20 million liquid cash, or a credit line from an institution of financing that shows that you have the ability to finance your way through this project. And if you don't have those things or can't get them, you may have to resort to a surety bond. And certainly a surety bond has a lower cost. You pay a one-time premium for that surety bond, and it may be able to entice your business partner or your client or your vendor to go ahead with a mutually beneficial project. But it's different than actually having the cash, because if that project fails and that company entity dissolves, the surety company may not have any recourse to subrogate their return of their output. They have to pay that obligee whatever their losses are. We're seeing a huge increase in the demand for surety bonds for projects. Not so much for license bonds, because there's not as many companies looking to get new licenses, but there are existing companies that are looking for an alternative to their normal asset-backed proof of financial solvency. And the surety bond does the trick. So far, the surety companies are not hardening the market to make it more difficult to obtain bonds. They look at the project, they look at the history of the principal, and determine if it's viable to go ahead with that bond. Look, if you're the obligee, you really don't have a lot of downside, because that bond should make you whole, as long as you verify the contents of the surety language to make sure it matches what you're looking to indemnify yourself from as far as exposure. Make sure it matches the language of your contract. Make sure it matches the identity of that party. Even if it's one word off from the name of the corporation, you may have some trouble collecting on that bond. So this is something that is an indicator of financial solvency of the general market. If the demand for surety bonds is through the roof, it's because exactly what it says here, financial instability. Companies don't have the same horsepower of money behind them to go ahead with a project, and they may be looking at surety bonds to kind of fill in those gaps and give something of value to their clients or their counterparties to make sure that there's no hesitation on going ahead with a large construction project, management project, consulting project, so that the other party, the obligee, has some comfort that they're protected if something goes wrong.